Well, howdy, folks. Welcome back to economics class, live from the backyard. I think I got enough sunlight to get through one of these before it gets dark. Well, we shall see. I have changed since the last time I wore this t-shirt, lest you be scared that I have just been sitting around and never changing my clothes for the last month. This whole outfit has been washed since the last time I wore it on here. However, I'm not going to lie, because Jesus said not to, so I will confess I haven't exactly changed my clothes every single day, but, it hadn't been like all week, in just a couple days, change a shirt when you feel like it, So anyway, on that note, we will talk today a little bit about stocks and bonds, the two primary kinds of securities, to kind of finish that section on investment. You guys only have a couple weeks left, so down to the second to last week of school, which is crazy to think about. But anyway, it's a sad day. But very soon, I will also have Mr. Fulcher's Country Song of the Day for the time that we were out, waiting for you, so that while you may have missed out on a lot of things in your senior year, you won't miss on having an amazing playlist if you want to make it. So I'll try to at least get you that, and we'll see. Hopefully we'll get to see each other again pretty soon here. But all right, so stock exchange is the place that stocks are sold. If you remember, we talked, last week about what stock was, and that is it's partial ownership of a company. So a company that is known as a corporation is going to be one that sells stock, or it sells these shares of ownership, and there's two reasons why that you would buy stock. So the first reason you would buy stock is for the payment of dividends. So you expect that at the end of a certain time period, which would be a year, it'd be paid out annually. At the end of the fiscal year is what they call it, the year that they kind of measure for economic purposes. At the end of the fiscal year, a corporation is going to divide up its profits, and all of the shareholders are going to be paid dividends. And dividends are just their portion of the profit. So let's say you're going to have a lot more than 50 shareholders in a major corporation, but let's say, just to keep the math easy, that there was 50 shareholders and they made $50 profit, and one person had 10 shares. Well, they would get 10%, so they would get $5 out of that $50 profit. Of course, you expect the corporation to be making a lot more than that, hopefully, right? So the portion of the profit that corresponds to your portion of ownership is the dividend. So that's one reason why you would want to buy a stock. The other reason you would want to buy a stock is if you believe that the price of the stock is at some point going to go up, you would buy it with the intent of selling the stock at a later point in time. And when you sell a stock and make a profit off of it, that is known as a capital gains. Perhaps you've heard people talk about a capital gains tax. That's a separate tax rate that you make that is separate than income tax that comes off of selling stock. So two ways to make money with stocks. One is the company, you hold the stock, the company is turning a profit, and then that profit is being divided up and you're getting dividends out of it. The second way would be to sell your ownership stake for more than you paid for it. And they say the old rule, this is just a very general truism, but the general rule is buy low and sell high. If you think you've reached the peak where your company is going to start going downhill and not making any more profit, but meanwhile you can still get a really nice stock price for it, that's the moment where it's kind of shrewd and smart to get out of there, sell off your ownership stake, and let someone else deal with the trip down. But then when you've got a situation where you've got stakes that are, where you've got a lot of stocks that are really low and they're really cheap, but you expect that they're going to be able to make a profit in the long run, that's an opportunity where you can make a great buy. I'm not, my dad was a stockbroker, not that you would think it to look at me right now, but for a little while, but I never really paid that much attention, so I don't know a terrible lot about, stock brokering, but I do know that this, to the extent that I understand things, it seems like this would probably be a pretty good time to invest in some stock, because you've got a lot of stocks that are kind of artificially low right now because of this whole health fiasco that you might expect to rebound from where they're trading at sometime in the next few years. So that's kind of the two ways you can make money from stock: are capital gains and dividends. There's two types of stock. One is common stock, the other is preferred. Common stock, you get voting rights, so you get to help vote on like CEO and board of directors and stuff like that. But you also have to wait to get your payout of your dividend until the preferred stock people have been paid. Preferred stock, you give up your voting rights in exchange for getting the first cut of the dividends, if you so desire. So that would be what you call preferred stock. And again, it should be said that no one is guaranteed to get a dividend or a capital gain. Right? There is such a thing as making a bad investment. If you've ever watched the 30 for 30 Broke on ESPN, a lot of people have made some really bad investments. So, if you buy a stock and then it crashes, you can lose your money doing that. The stock market is a little bit of a gamble. But so is opening a business. That's economics for you. Sometimes things work, sometimes things don't. That's why you gotta, be sharp about this stuff. So, anyway, where was it going? Stock market. Okay, yeah. So stock market. Your dividends, may not come if the company loses money, which a lot of corporations are going to lose money this year, and so people were expecting dividends and they're not going to get them because the company lost money because of all this stuff. So, that's kind of the risk that you run. Typically, most people don't buy stocks directly from the company themselves. Most people go through someone who's called a stockbroker, and a stockbroker is someone that they normally work for what they call a brokerage firm, and the people that work for a brokerage firm are going to be selling the stock. Buying and selling the stock as they see fit. And so again, a stock portfolio is kind of a heck of a thing to manage by yourself while you're also, doing whatever job you were doing to get the money to invest in the brokerage firm, that you went to the brokerage firm to get invested. So the broker is more attuned to the ups and downs, of the investment, and so a lot of people will kind of put it off on him. Although again, he works for you, so if you tell him, say, I want to buy into this field or whatever, he'll hopefully listen. The largest stock exchange, which is basically the marketplace where people go to buy and sell stock, is the New York Stock Exchange in New York City on Wall Street. And so, you've probably heard Wall Street used as kind of just a code word, a shorthand for business in general. And so, on Wall Street at the New York Stock Exchange is the largest marketplace for stock. And there's a few other ones, though, as well. So some stocks, instead of being on the NYSE, trade on the NASDAQ, which is another one. And then there's international stock markets as well. So there's stock markets in London and in Beijing and a bunch of different other places. But Wall Street in New York is the most famous one by far. There's a couple things that are related to stocks you might want to know, but one is something that's called a future. So a future is a contract to buy or sell a commodity at a specified future date and price. An option is a similar contract that gives the right but not the obligation to buy or sell. So your book gives an example. So a farmer might use futures contract on a crop of tomatoes to lock in a high enough price to ensure a profit, or a corn processing plant might sign an options contract for the corn, giving it the right to buy it if prices don't raise so high. So they created these predominantly for agricultural goods, but now they do them for some other things as well. If you've been following the news, you may have heard about the insane development of oil futures actually going into the negative, where people are actually kind of oil companies are paying to get to take it out of storage for the first time because there's been this huge crash in demand because nobody's driving, so no one needs it. So that's and of course there's some stuff going on with a output production war between Saudi Arabia and Russia that's having a role in all that as well. But that's kind of what stock options and futures are. It's where you either a future is like you basically, buy the stuff ahead of time, or an option, you buy the right to purchase it provided certain conditions are met. So perhaps you've heard people talk about the Dow went down or the Dow went up, or what does that mean? So what that is, that's a reference to the Dow Jones Industrial Average. And that is an average. It kind of calculates, like the average of what the stocks are going for. And it reports the change. Some other important ones are the NASDAQ Composite, the S&P 500. There's different ones from the Japanese markets, the Dutch markets, et cetera. But in the U.S., you mainly are concerned with the Dow, the S&P, and the NASDAQ. All right, and so one thing to keep in mind, the S&P is a little bit more inclusive. So the Dow Jones Industrial Average is actually taking the average of several of the major money or blue chip stocks. They only have 30 companies, and they're the ones you would expect to be the 30 most profitable. So the S&P is actually kind of a better representation of kind of the national average, but the Dow Jones is kind of a measure of how the stocks that you would expect to really represent the top of the economy are doing. And you may have heard the phrase bull and bear market. That's kind of Wall Street slang that describes whether the economy is good or not. So a bull market occurs when stock market prices are rising steadily over time, and a bear market occurs when they are declining steadily. Typically, a 20% increase over at least 2 months is considered a bull market, and a 20% decline over 2 months is considered a bear market. And again, bear market's not a good thing when you talk about a 20% decline in the value of stocks over the course of, a 2-month period. Of course, we've had some very recent encounters with that. After just before that having a pretty prolonged bull market. All right, so meanwhile, that's stocks. The other major type of security is bonds. And bonds, we've talked about a little bit as well, which is where you basically buy the right to cash that bond back in with interest later. It's essentially a means of borrowing. So if you buy a $100 bond, you are paying $100 right now, or basically lending your money to the person that is going to pay you back when the bond reaches what they call maturity. So par value is the amount a bond issuer has to pay the buyer at maturity. Maturity is the date when the bond is going to be repaid. The coupon rate is the interest rate a bondholder receives every year until maturity, and yield is the annual rate of return. So if I were to sell you a bond, then I would have to agree. I would be taking your money in the short term to kind of raise money for whatever it is that I need the capital I need for my investment, and we would agree to a coupon rate, which is an interest rate that is going to attach to every year up until the time of maturity. So if we agreed that you're going to pay $100 now, there's going to be a coupon rate of a certain percentage every year that's going to get added on and until the date that's considered the maturity date. When we reach the maturity date, I have to pay you back what they call par value, which is which is your principal plus the interest, essentially. And the annual rate of return on the bond is known as a yield. So a high yield bond would be one where you're getting good return every year on it off of the interest payments and so on. And then a low yield bond would be one where it was not paying much out in interest. There's a couple different types of bonds. You can get treasury bonds, which is where you're actually borrowing from the national government. And when we talk about the government being in national debt, which we'll talk about in more detail later on, sometime in these last 2 weeks here, what exactly that means, who it's to. Basically, the short version of that is who they owe it to is bondholders, because they've paid for a lot of the stuff like Social Security payments and stuff like this based on having sold government bonds. And it's, and now there's, trillions of dollars has to be repaid. In fact, a tremendous percentage of our annual spending, a shocking amount of our annual spending, is just interest on the bonds that the government has sold to raise money for funding itself. So, municipal bonds are bonds that are not federal bonds, but by state and local governments. And they're often used to do things like build bridges, schools, stuff like that. And typically government bonds are considered a fairly safe investment because governments can tax people. So the idea that, it's unlikely that they're going to default because they can always raise taxes, and that kind of a thing. Now, of course, the problem is, as we've seen, it's possible, the federal government is pretty much always going to get the money at once, although the crash is going to come inevitably at some point if we can't rein in the spending rate a little bit. But or dramatically increase the income. But state bonds are typically safe too. However, there have been times where states have had to default and actually not pay back the bonds. Because when you buy a bond, you are taking a risk because it's entirely possible that the person is not able to pay you back at that time. Basically, the interest rate that you'll ask for is going to be dependent on how that bond is rated. If that bond is what they call a junk bond, it means it's a high-risk bond. It is entirely likely that a junk bond means a bond that is likely to default, meaning it's a high-risk, high-yield situation because there's a very good chance this company is going to go under. You're not going to get paid back. But if you do get paid back, you had it at such a high interest rate because of the danger that you're going to make a lot of money when they do pay it back. So that's what the idea behind a junk bond. So somebody who's buying junk bonds, they're hunting for gambles. They're understanding that they could lose a lot of money in this situation, but they also could hit a windfall if that company does well. Government bonds tend to be considered a safer investment because, again, they're probably going to tax someone and come up with the money to pay you back. Although the problem with that, as we'll see, is some of the policies they would resort to guarantee that the creditors get paid back with the debt the way it is might cause inflation to eat away the purchasing power of the money you get paid back on. So you may get paid back on paper what you were supposed to get, but it actually buy you a lot less than you would have because the way they paid you back was inflating the money supply. We'll talk more about inflation later on this week. So we got that done relatively quick, which is good because I was about like 1 day short of being able to finish everything I wanted to finish. So we could probably double up something and not waste your time too bad. So anyway, y'all have yourselves a good one, and see y'all around.